Welcome back. We're about a minute and a half away from the producer price index, so we are on countdown mode. Futures have worsened. Take a look at where we stand on stocks. The Dow Jones Industrial Average now down almost 500 points. That is almost 1%. The S&P is down 0.75%, and the Nasdaq down almost 1%, down 202, ahead of the January producer price index. Let's check yields and the 10-year right here, because earlier it broke 4%. Where is the 10-year right now? Yes, it is down below 4%, down almost 2 basis points at a level of 3.98%. Rates are falling. The January producer price index is out any moment. Economists expect an increase of 0.3% month to month and 2.6% year over year. Let's get into it with Navellier Associates founder and chief investment officer Louis Navellier. Louis Navellier is with me. Louis, great to see you. How important is this PPI to give us a sense of inflation at the producer level? Will it change your assessment of the stock market and how to allocate capital?
Well, it's just going to be another signal that the Fed might be able to cut. I mean, obviously, we have a lot of big layoff announcements that's starting to concern people. But I want to see the service costs remain tame. They have been tame. And we want to see the good costs fall. We had an extraordinary jump in goods prices from the trade calculations they do. So we want to see that cool off. So I'm more interested in the components of the PPI. But we should be importing inflation from China, deflation from China. Yeah. And that's why TV prices are so cheap.
Okay, that is a very important point that you just made in terms of services costs and the cost of goods. Let's get right to Lauren Simonetti. The numbers are out on the producer price index for the last month. The Dow Industrials has worsened. It's down 520 points. Lauren.
Yeah, so the numbers are hotter than expected. Producer prices for January up 0.5%. That is hotter than the 0.3% that was expected, and it matches December's number. The headline number coming in better, lighter than expected at 2.5%. The expectation was 2.6%, and that was less than December. Good news. Let me get you your core numbers. If you strip out volatile food and energy, core prices coming in at 0.8%. Maria, the expectation for January at the core level was 0.3. That is hotter than expected, and when you're looking backward, hotter than December too. Year over year, 3.6%. That is the number to know. Core PPI year over year in January, 3.6%. The market is selling off further on this information. Obviously, this is a leading indicator into consumer prices. Maria, I'm going to look back into this report. You can come back to me if you like with more.
Lauren, we're going to get back to you as you drill down on these numbers. But Louis, your first reaction to this when you strip out food and energy, it's up 0.8%. The headline number up 0.5% on the PPI. I'm not surprised because we are seeing money move into hard assets, and the underlying components of critical minerals have been rising. But what's your reaction to this PPI for January, Louis?
Well, I got to dig in the trade services. The trade services screwed up the report in the previous month. It looks like it's screwing up here, but I don't have that actual number. But hopefully, once we back that out, it won't be that bad. But yeah, that's been the problem, is the trade services impact, and that's new. They didn't have that a few years ago.
I see. So it's been the trade services, and you want to look at the cost of services. But, Louis, you've been a growth investor and one who has been incredibly successful over many decades. You've gotten this rotation in this market recently. Tech, software, very volatile in the month of February as investors are watching this AI disruption risk, fast-changing capabilities. You have Jack Dorsey's fintech company Block this morning saying it's going to cut 40% of its workforce, 4,000 employees, because these new AI tools will replace human work. Your reaction to what's gone on in the market? Block, by the way, is up 20% right now in the pre-market. How are you rotating, or are you rotating, following what we are seeing in the macro, a broader market where rotation is clearly underway out of big tech?
Yeah, no, I didn't change anything. I'm heavily invested in the data centers. I own Eli Lilly, which is a big weight, and I own over 20 gold stocks. And obviously, I was ecstatic with NVIDIA's results. I think that profit taking is just the option writing. You know, they write so many options on NVIDIA. A lot of those people that wrote the options don't want to deliver. They'll run a mean reversion program and knock it down. but obviously this was a stunning earnings announcement season. So, but it's still a very narrow market, and there are a lot of job concerns. Christopher Waller, the Fed governor, has brought it up. He thinks if there's a bad February payroll report, he's going to be pushing for cuts at the March meeting. So we'll see. But yeah, that's the more people you lay off, the faster your tech stock goes up, and that's very obvious right now.
Yeah, that's unfortunate. So in terms of this market, do you want to look at a 575-point sell-off in the Dow as a buying opportunity, or do you want to take to the sidelines and let things settle out for a bit?
Well, I suspect I'm not going to be that affected because of all the gold stocks I own. I know on Monday when it was down 814%, I was up on 80 stock portfolios. So some of that was the techs being resilient. A lot of it was the gold bet I have, and so I'm not changing that bet. And so I think I'll sell through this just fine, to be honest with you.
And you're talking about the gold miners. Is that the way to go, buying gold mining companies as opposed to buying the actual bullion?
I think you have to buy the gold miners because it's hard to find the bullion. I mean, go to Costco, it's sold out. You can't buy the bullion because most gold dealers are short. So I just think the gold miners are an easy way to do it. Now, my gold miners all make money. This is an area where you get into where not everyone will be reporting their financials perfectly, but mine are all report. They all make money. There's tremendous margin expansion. And this is a global phenomenon. There's just a lack of confidence in central banks. The quantitative easing, in the Bank of England, the Bank of Japan, the European Central Bank, is going to be relentless because they're losing households, people paying in the system, and they can't manage their deficits. China, in my opinion, the only way they can fix that deflation they have over there is to devalue their currency because their rates are already lower than Japan. So as you look around the world, there's just incredible insecurity, and the oasis is the U.S. dollar and gold, and that's where your money should be.
Really great assessment there. Gold prices right now well above 5,200 right now, 5,240 in fact. Louis, good to see you. Thank you, sir. We'll be watching.
Thank you.
Louis Navellier,